The world's central banks have a warning institution, and right now it is raising alarms on three fronts at once. The Bank for International Settlements, known as the BIS, has released its latest assessment of the global financial landscape. The Basel-based institution coordinates policy thinking among the world's major central banks, and its risk appraisals carry real weight with policymakers. Its latest message: several long-running vulnerabilities have not been resolved, and new ones are forming on top of them. The first concern is government debt. During the pandemic, many economies borrowed heavily to keep things afloat. Those debt loads have been slow to come down, and that matters more now because interest rates rose sharply in the years that followed. Higher rates mean governments pay more just to service what they already owe. That squeezes public budgets and leaves less room to respond when the next downturn hits. The fiscal cushion, the ability to spend your way out of a crisis, gets much thinner when your balance sheet is already stretched. The second concern is inflation. Price growth has come down considerably from its recent peaks in many countries, but it has not fully returned to the targets most central banks have set. That puts monetary policymakers in a tight spot. Cut rates too quickly and inflation could re-accelerate. Keep them high too long and growth slows. Borrowers get squeezed and economic momentum fades. The BIS is essentially flagging that the last mile of the inflation fight is not yet won, and the path to the finish line is narrow. The third concern is newer and harder to measure: artificial intelligence. The BIS is not dismissing AI's potential. Faster productivity growth would be welcome across the global economy. But the institution is raising pointed questions about what rapid AI adoption could mean for labor markets, for financial market dynamics, and for regulatory systems that were not built with this technology in mind. Uncertainty itself is the risk. When you cannot predict how a technology will reshape the economy, it is difficult to price in or prepare for the consequences. What makes the BIS assessment particularly notable is the connection between these three threads. They are not separate problems sitting in separate boxes. A shock to growth could make debt harder to manage. Stubborn inflation limits the room central banks have to respond. And AI introduces a wild card that existing frameworks may not be equipped to handle. Stress in one area can amplify stress in another. The practical read for anyone tracking macro conditions: watch how central banks balance rate decisions against these longer-term pressures. The margin for error is smaller than it looks. This briefing is brought to you by First Financial News, clear daily coverage of the economy and markets at firstfinancialnews.com.